we have a release coming in from the Adani Group as well. It's a deep dive on the credit risk of the Adani portfolio as a whole. Agam is here to break that down for us. Agam.
Right, Harsh. So we're actually talking about Adani Group's risk profile at the moment. And, at the end of the first half of this financial year, we've had several updates. This is a reiteration of the stability of the group at the moment. So firstly, they start off by saying that the portfolio has about 60% of its equity deployed in assets. And the reason why this is a good number because anything over 50% is strong, and 60% is certainly very, very strong. It means that a higher equity deployed in assets also means better stability. Moving on, the company also says that it has a very well-distributed sources of funds. This again indicates lesser risks since the higher number of sources of funds, the better it is. Moving on, they also talk about earnings from contracts. That stands at 70% of your overall EBITDA. And the reason why this is important is, well, it indicates not only stability, but also visibility in terms of earnings going forward. Because do remember, a lot of these contracts do mean, which span out for over many years, do mean that you have that much more stability and visibility with respect to earnings. Now, what do the earnings mean when it comes to borrowings? That's actually is leading up to the next point, that is the portfolio borrowing is less than 2.5 times of the EBITDA. Naturally, this also is an indication of the group's ability to service debt. And do remember that this number has come off substantially from well over 3 times last year. And finally, the company has also indicated the portfolio cash reserves stand at 20% of your overall borrowing. This also means that this lowers, credit risks going forward. So a lot of these factors, a lot of these key factors come together, and if you stitch them up, it's a clear indication of the group's health with respect to its borrowing and its credit risk at the moment.